Hello everyone. Today we're going to talk about understated and overstated inventory. Often you'll see problems like this where an item such as inventory or some other thing has been overstated or it's been understated. In other words, there was an error made in counting an inventory. This will have an impact upon gross profit. We're going to show you how to do that, but first I wanted to mention to you that I believe something great is going to happen for you today. Now to the video. I'm Professor Capko and I help students better understand accounting, law, math, and other subjects. So if you like this type of material, please subscribe to this channel, give it a thumbs up, and pass it along to your friends. Thank you. All right, we're going to talk about understated and overstated inventory. In our example, we're going to say that we had net sales of $650,000. We have a beginning inventory cost of $250,000. In other words, that's the inventory that is in the warehouse or in the store to sell to customers. We paid $250,000 for it. During the course of the period, additional purchases were made for inventory items totaling $600,000. So $600,000 was added to the inventory. At the end of the inventory period, or at the end of the accounting period, an ending inventory was taken and $300,000 worth of items are in there. My first example, I'm going to do it correctly. In other words, we'll presume that the beginning inventory and the ending inventory are correct. So there are no errors. In the following examples, we'll make some errors so you can see how they play out. So we're going to have an income statement that looks like this. You can see throughout how it'll work. We're going to start out with the sales. As we said, there's net sales of $950,000. Then we're going to calculate our cost of goods sold. We are told that the beginning inventory is $250,000. We then purchase $600,000 worth of items. And we then want to find out the amount of goods that are available for sale. This is the total amount, which would be the beginning inventory plus all purchases. So we're going to take the beginning inventory, we're going to add purchases to it. So we take the $250,000 and we add the $600,000 to it. So the goods available for sale. This is not our ending inventory. This is just the total goods available during the time period that we could have sold. And that is $850,000. We just add those together. Then we have a correct ending inventory. So I'm going to show you we've got $850,000 as our goods available for sale. In this example, we're going to, at this point, have a correct ending inventory of $300,000. So in other words, that's how much is left in the warehouse to be sold to customers at the end of the accounting period. So we have to subtract that from the goods available for sale. So we have the $850,000. We're going to subtract our $300,000 from that, and that's going to give us our cost of goods sold. So the stuff that went out the door with our customers cost us $550,000. That was our cost. The $950,000 is our sales. We take the $950,000 and we subtract from it our cost, then the $550,000, and that's going to give us our gross profit. I do that on the calculator without having to re-enter everything by just turning this to a negative by hitting the plus minus sign. So I turn it to a negative and then I add the original $950,000 to it, and that gives me our ending amount here, our gross profit of $400,000. So we have a gross profit of $400,000 when everything is done correctly. Next, we're going to have the exact same numbers that we started with, but in this case, an error is made in inventory. The ending inventory, instead of being $300,000, is overcounted and was found to be $400,000. Perhaps some pallets were double counted or something. Who knows? Human beings make errors. This happens all the time. We just have to see how it plays out. So we've overstated the inventory by ending inventory by 400,000. So we're going to start out with the same numbers here on the right hand side, the same sales numbers, the same beginning inventory, the same purchases. We add the purchases together and we get the same goods available for sale. So I'm going to go ahead and put that in my calculator for the 850,000 is our goods available for sale. But our ending inventory, which we know from a bird's eye point of view, from an educational point of view, is incorrect. But at the time, they don't know it's incorrect because they would have corrected it. They just presume that it's correct. So we're going to take that amount and we're going to subtract that from our goods available for sale. And that will give us our cost of goods sold. So we subtract that and it gives us a cost of goods sold of 450,000. Notice how that compares to the cost of goods sold when we did it correctly. Our cost of goods sold is less. It is less than our correct cost of goods sold. And if we think about that, that makes sense. If our ending inventory has been overstated, in other words, we double counted something, we counted or priced it wrong or something, we have too much in the ending inventory, there's more here stated here than is actually in reality there, it looks like we sold less inventory. And that means if we sold less inventory, fewer items, that means that our ending inventory is higher and our costs of the items that went out the door would be lower because some stuff went out the door that we didn't account for. And I don't mean that it was theft. I just mean that we double counted something so we think we have it, but it actually was in our customer's shopping cart. So if we have we have 450,000 as our cost of goods sold, and I take that, I'm going to do my same trick again. I'm going to hit the plus minus sign to make it negative. I'm going to add back in the net sales, and that gives me a gross profit of $500,000. Again, our gross profit is higher where we've overstated the ending inventory, so our gross profit actually will be higher than it should be. Our gross profit should only be 400,000, but in this case it's showing a higher amount because of this error. Let's look in reverse. Let's look at another situation where we've understated, and that will make it even clearer. So in this example, we're going to use the exact same numbers, and on the left-hand side, I've just repeated everything. We've done it correctly here on the left-hand side and arrived at the same correct $400,000 gross profit. But in this world, we undercounted, we understated the inventory. So there was something they forgot to count, something that somebody was in charge of counting and they didn't, or they added wrong, something happened, and they have a final inventory of only 200,000. So everything else is the same. I add the 250,000. That is the beginning inventory. I add it to our purchases for the year. These are correct numbers. This is a correct number. That gives us a goods available for sale of 850,000. I'm going to subtract, if I've got the 850,000, I'm going to subtract from it our unknowingly incorrect ending inventory. And that gives us a cost of goods sold of 650,000. Again, we're going to compare that to our cost of goods sold, which would be correct, the 550,000. In this case, the cost of goods sold is overstated. We understated the ending inventory, but we've overstated the cost of goods sold because there's some items that we didn't count, but we think they went out with the customer, but they didn't. They're actually still sitting in our warehouse, and we just didn't count them. In this case, $100,000 worth of items. So I'm going to take my $650,000. I'm going to do my same trick again and change the sign, make it negative $650,000. I'm going to add to it my sales revenue of $950,000, which is the same. We haven't changed that. And in this case, our gross profit is $300,000. And you see here, the $300,000 is less than the $400,000, which is the correct amount. So where we've understated the ending inventory, we wind up with a lower gross profit than it should be. So we understate the gross profit if the understatement is of the ending inventory. So take a look at that. That's how it plays out. You now know a lot about understating and overstating of ending inventory. There's more that you're going to need to know. So if you found this helpful, please smash the like button and go ahead and subscribe to keep your grade alive. Thank you.